Yeah, there are two ways we think about integrating ESG into the investment process for this product, and first is really at the portfolio construction or index construction level, and we do that by focusing on some key climate metrics, really, and thinking about how do we want to affect change in a portfolio like this, and we come up with some composite metrics to tilt towards what we deem some climate leaders and away from climate laggards, and that might be using things like emissions intensity, how much do they have as far as fossil fuel reserves go, and what are the opportunities for some of these companies? Do they have some green revenue? Are they starting to shift their business models? So it's really at that step where we kind of change the weighting, based on some of those key metrics. Once we have portfolio construction sorted and we're happy with the outcome, there's also ongoing engagement. So kind of a second level of ESG integration. And the first step is our climate impact pledge, targeted engagement with some of the most important companies in the world with respect to helping us along this climate transition. And we really focus on those companies, and again, reward leaders and take out any severe laggards that are failing to meet our minimum standards. And that's really a focused effort by our investment stewardship team. And then the last step is just ongoing engagement. So there'll be a lot of companies that'll still be in this product. A lot of companies that we're hoping are doing great things, both on ESG and on how they're represented from a factors perspective. And we'll go out and talk to them about key issues, trying to lift the boats, if you will, for all market participants. So kind of multifaceted, multi-layered. Start with portfolio construction, bring in some key climate components, and then make sure we're engaging with anyone who's left over. Yeah, there are a lot of really good examples I think we could point to, and if we hone in on that climate impact pledge, that targeted engagement effort that's been live since 2016 and has gotten some really great reviews and great responses, I should say, is one where I think we can pull out a couple names, and so that pledge, the climate impact pledge, is really about focusing on some of the most important companies in the world and helping them along with their climate strategies, and anyone we deem failing to meet some of our minimum standards could be excluded from this fund. So we would knock them out as kind of a last step. It's that last big stick if we don't see good action on some of the major constituents. And I guess bringing that to light, we're focusing on things like the governance of the company, the climate governance. Do they have a climate strategy? What are they thinking about their risks and opportunities are for the climate transition? We do some scenario analysis and of course have some metrics and key target settings. Are they setting a net zero ambition? So that's kind of the framework. And then we've got key requirements for various industries as part of that pledge. So a good example will be Kroger in the food industry. What we're thinking about there is supply chain management. Is the supply chain decarbonizing? What are they doing on high impact versus low impact products on their shelves? Are they promoting them? And Kroger was a company who was previously divested, deemed a laggard, and since reinstated. We've got some great material on it and why, but essentially they've started meeting some of our minimum standards. They've started to focus on their products and start to market or showing evidence of marketing some lower impact, plant-based products, and they're also looking at the deforestation as part of the supply chain effort and working with companies or partners like CDP Forests to really dig into the detail and make sure they're setting appropriate targets and following through on them. So I think those are the kind of examples that we're seeing. You could point to autos as well. A lot of net zero ambitions coming out, and that's the kind of reaction we're hoping to have as we target these companies and really engage with them and help them along. So factor incorporation in an index is an important component we feel for certain investors' portfolios. The goal there is to harness kind of two things. One, exposure to what historically has been deemed a compensated risk, and you're kind of hoping to get rewarded for that risk. And two, delivering more diversified exposure, which can go, really well with other parts of a portfolio. So, how do we go about doing that? What are the factors included? We're focused on things like value, so companies that are showing a price that is cheaper than some other fundamental metric, like the book value of the company might say, or the earnings may say. So finding companies that may be mispriced in the market, that's what we're trying to harness. quality companies, stable earnings, companies that have that consistent return, can sometimes offer a benefit to a portfolio. Smaller size companies, it's not just about the big winners who are always in the news. The smaller companies can often deliver some strong results and can help you get a more diversified exposure, as well as you kind of under allocate to the largest companies in the world and over allocate to some of the more mid-sized companies. So that'd be a key component. And then last is low volatility, which is incorporated as well. Trying to harness companies that are exhibiting a lower risk profile. So if I bring these all together, I can get this balanced exposure to a lot of factors that on their own right have shown some promise over historical periods, and hope that over long periods I can kind of extract that benefit. Find those companies that are cheap relative to what their price is saying. Companies that are exhibiting a lower vol and are having a positive impact on my risk adjusted return. So it's a strong way of kind of combining the exposures to where there's a lot of academic research behind the benefits there. Factor performance has been a bit tumultuous, I would say. Not just last year, but over the kind of the 10-year horizon, post the financial crisis, when a lot of these products came into market. And it's really been an interesting story. Lots of push and pulls on when factors are doing well, when they're not. There's been a strong growth-oriented market. Equity returns have been very strong over the period, including the last 1 year. And I think we haven't seen as many, traditional cycles as you may have seen going back further in history. And I guess that's an important caveat or an important point to pull out, because individual factor performance is quite cyclical. It depends on how the overall economies, both regionally and globally, are growing, and you can kind of pinpoint when we expect them to do well and when they don't. Obviously, the past kind of year and change and year to date, it's been a pretty volatile market with all of the events going on in the world. And so factor performance has definitely peaked and troughed. But the highlights this year, to pull them out, quality has been a very strong performing factor. We've seen it quite resilient, a few percentage points better than market. Value has had a very large bounce back, and is has since stabilized, but is one of the outstanding factors on kind of the 1 year and the year to date. Explains most of the return or the excess return of this strategy relative to market. It would be that value factor. So one to look out for. Value is always one. It's kind of a coiled spring. It gets pulled back, and eventually it can bounce. But I think, as we see global economies open up, as we see some normality hopefully restored, I think we can hopefully pinpoint some additional winners out of the mix of factors that this strategy is offering. So the highlight of the year, and it's ongoing, it's coming in two parts. A bit of a modernization to the strategy, and shows how important this strategy is to us and hopefully our investors. The market is changing very rapidly, and best practice, best thinking is always moving on, and that's especially important with ESG integrated products, and one that focuses on climate like this one does. And so what the highlight would be is a methodology change that we've enacted, and it's coming in two rebalances to make sure we've smoothed any potential turnover as a result of it. But we've incorporated the transition pathway initiatives scoring framework. So in addition to some of the climate metrics that we've had historically, carbon emissions intensity, reserves intensity, looking at green revenues, we've also brought in carbon performance and management quality. And so, not available to us previously, now available because of all the great work going on in the market and on behalf of the TPI. And what that'll do is it'll help us get a bit more particular about who we're giving or allocating our emissions reductions and to basically in the strategy. So we can look a little bit more granular into the detail. What companies are actually starting to shift their business? What companies are more aligned to a 2-degree scenario versus a company who's not aligned. And so those additional metrics just allow us some more precision on the climate objectives. We've also improved the balance of the factors that we built into the strategy. Something again that was developed very recently, and we're proud to say is part of the strategy. And why is that important? The strategy has always been about climate and balance factor exposure. But if we can be more precise about ensuring that balance, we think that's a great outcome, and making sure that no one factor is driving the overall performance of the strategy, and kind of future proofing it. So definitely the highlight, being able to evolve the strategy, being able to make sure that it's still one of the best strategies we have on offer, and is still doing the same thing we set it out to when we launched it back in 2017.